Stocks see volatile trade with the Sensex and the Nifty trading flat. Mid-caps are mildly underperforming. Industrials and financials are clocking some gains, while realty and auto are the big drags.
Inflation plunges below RBI's forecast, dragged down sharply lower by lower food prices. Bond markets now see rate cuts in April and June policies. Some even see RBI changing its stance to accommodative in April.
Prices of metals surge as US import tariffs kick in. Aluminum, copper and steel command hefty premiums in the US over their LME prices.
The Oilfield Amendment Bill has got parliamentary nod, paving the way for more stable and predictable framework, easier licensing, operational flexibility and speedier dispute resolution. While the minister lauds this as historic, analysts see it spurring investments.
The best case scenario for India would be striking an FTA with the US, and the US imposes tariffs on China, according to former RBI Governor D. Subbarao, who said this to CNBC-TV18. Now, in an exclusive interview, he also added that the RBI should not intervene too much, but allow market participants to adjust to volatility.
Well, it's a volatile trading session. You're watching us here on Halftime Report. I'm Mangalam Malu. With me, Hormaz Fatakia. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. What's interesting about the market is at lower levels, it is finding demand. At higher levels, it sees some supply. Nifty Bank is outperforming today. The mid-caps, however, have done a bit of a U-turn. They were outperforming in the earlier part of trade, but now they're underperforming, with more stocks declining than the number of stocks advancing. Perhaps ahead of the three-day weekend is the mood of profit-taking on the street. Let's see where we go. Hi, Hormaz.
Hi, Mangalam. We would want to go into a holiday weekend with some gains, but we are looking at a bit of a reversal from the last two sessions. We're making lows and then recovering. We are now at the lowest point of the trading session, and it'll be interesting to see whether we recover from that towards the close. Again, 22,450. That's the level that the Nifty has to defend. It has been closing above that for the last 5 trading sessions, and it would be looking to add a 6th one to that, trading very close to those levels as we speak. A pocket that has done very well today and has been doing so over the last couple of weeks is the defense space, and those are the ones that the names that are dominating in today's list as well. Data Patterns is the top gainer on the Nifty 500, 6.5% higher, and of course all of these shipbuilders, you can't let go of them, be it Mazagon Dock, Cochin Shipyard, Garden Reach, all of them trading 2.5 to 4% higher. They had a very good week the last time around, and they are looking to build on those gains. But the other defense name that has been in the spotlight over the last couple of weeks is Bharat Electronics, and that is the top Nifty gainer today, and that's after another 2,500 crore rupee order that it has won. Upasana is joining in to tell us more about that order and what does that do to the company's FY25 guidance. Upasana, good afternoon.
Good afternoon, Hormaz. Well, certainly the defense major BEL remains in focus today, and the month of March has boded really well for the company in terms of slew of orders received by the company, and company is certainly marching towards its FY25 order inflow guidance, that is around 25,000 crores. Now, coming to the current news, the company has received yet another significant order for a fully indigenous Ashwini radar from Indian Air Force worth nearly about 2,463 crores. Mind you, BEL has received order inflows worth 7,200 crores till now in Q4, and company has reiterated order finalization worth rupees 12,000 crores is expected by 31st of March, is what the company has indicated in Aero India conference. Now, FY25 order inflow till now is 17,000 crores versus 25,000 crores guidance given by the company for FY25 as stated earlier. Now, looking at the valuation, BEL currently trades at a PE of 27 times for FY27. Now, mind you that the company's key focus is on diversification of its book with a medium-term goal of revenue target of 25 to 30% from non-defense segment. Now, on the back of this order win, Phillip Capital maintains an ad rating on the stock with a target price of 390 per share. And Nomura has also said that the company is on track to achieve its guided order inflows. And the company has indicated that it is in the final stages of multiple negotiations with the customers. Hence, this stock remains in focus And let's see if the company is able to meet its FY25 guidance.
Take that point, Upasana. Thank you so much for that. Let's talk about Adani Green. That's the other stock which is surging. This is on the back of an initiating coverage coming in from Macquarie. Sudarshan joins in to tell us more. Sudarshan, stock up 3%. What does Macquarie like?
So first, two positive news in last two sessions. First, yesterday JP Morgan has moved two of its restricted group bonds to overweight category from neutral, and yesterday also the stock was up around 3%. Today also it has moved up to 5%. Now it has seen a bit like downtick from day's high, and it's after Macquarie has initiated coverage with outperform call, and target is 1200 per share, implying an upside of almost 40% from current levels. What does Macquarie say? It says that it's leading India's energy transition, and its targeted capacity of 50 gigawatt by FY30 would be an increase of almost 5 times from current level of 12 gigawatt. Also, it said that conservative estimates also estimating that it would see 25% EBITDA CAGR over next 5 years. Regarding the operating cash flow, it says company expects $1.8 billion annual operating cash flow, and despite the high capex, Macquarie believes that net debt to EBITDA will fall to 5 times from current level of 7 times by FY30. So factoring all these things, you are seeing an uptick in Adani Green stock.
Indeed, good going for Adani Green Energy. Slightly off the highs of the day, but still holding on to gains of around 3%. Mind you, the stock is off 60% from the peak, which was well over 2,000 rupees. Just before we take that break, look at Bharat Forge as well. It's down to the lowest point of the day now, 4% lower on the stock. We'll get you more on this as the show goes by. But we take a short break. As of now, more on the markets and specific stocks on the other side. Stay tuned. Welcome back. Now here's a CNBC TV18 exclusive for you. Skincare startup Minimalists co-founder and CEO Mohit Yadav told us that they will continue to run the ship even post the HUL buyout. He told Shireen Bhan that they hope to turbocharge expansion plans with help from the FMCG behemoth. Listen in to a slice of that conversation.
You pretty much will continue to operate as an independent island within the large HUL framework. Now, how did that come about?
It was an easy decision. We needed this to happen. They were also aligned that this is how it should work, right? We should continue to operate where we are doing. We should continue to do what we have been so far. So I guess.
So you run the ship.
We run the ship. Yeah. So
There's no change in that.
No change in that.
Even though ownership has changed completely.
Yeah.
Give me a sense of how you turbocharge the growth ambition and the growth plans for the company from
I
here.
think the three very easiest growth lever, one, as I said, is our offline expansion. So with them, we know which store, what data, what is relevant, not relevant, then exploring this entire piece, understanding, for the next 2 years, how many stores are relevant for us, how to plan. They already have an on-ground team. We can leverage a lot of those things, right? So I guess so far we are in some 2,000 stores, and we took almost 12 to 18 months to be here. In next 2 years, we can easily target anywhere between 15 to 20,000, right? 10 times more than what we have achieved. And all that, again, can be done very seamlessly. Second is international. While, of course, we started working in these markets, we have some bit of retail partnership. But every new market you enter, you have to, again, figure out who are the right channel partners. You have to have those relationships and all.
And that's where the Unilever system will kick in.
And that cycle take anywhere between 4 to 6 months, right? Again, with HUL, given they are present in most of these markets.
Yeah.
And now, because of their prestige portfolio, even we know, say, which channels have performed better, say, for Paula's Choice, K18, other brands, then what should be our distribution strategy? All that is now easily accessible. Third is their the global R&D centers. Whatever we have been doing in terms of our own clinical studies, test, evaluating ingredient, they have been working on multiple things.
Yeah.
So we have a easy resource we can tap in.
Insightful conversation there. You can catch all of that on Young Turks Reloaded. What we'll do is take a short break. On the other side, focus on the market technicals. Ajit Mishra of Religare Broking joins in with some trading strategies. Back, the Nifty is close to around 22,450. That seems to be a bit of a fulcrum for where all the options would be today. We'll keep an eye out on that in just a bit when we talk about the F&O end of things. ONGC, after dipping, has now started to move higher once again from the lows. We're seeing some traction in, BEL, which continues after the order win. Coal India as well has moved higher. But if you look at the broader markets out there, you have a couple of stocks which are actually at, the lows of today's trading session so far. And that includes the likes of Persistent and Emphasis. Both these IT names, they've actually been a bit of a turnaround after this morning. We saw good news coming in from NASDAQ overnight. Stocks which are moving well and at the high point of trade, delivery is doing well. CESC has picked up some pace, and we have United Spirits as well, perhaps ahead of the long weekend, picking up some pace as well at the high point of trade. But let's move on. Let's get you a network exclusive. Money Control's Bodhisattva Ganguly caught up with Stephen Schwarzman, who is the chairman and CEO of the Blackstone Group. He spoke about the comments about the Blackstone Group's growth in the Indian market, US-India trade negotiations, and growth prospects of data centers in India, an area where Blackstone has been making a lot of investments. Listen in.
When we decided to come here, we announced that we would put $1 billion in India.
Right.
And people here probably forget that 20 years ago, that was a huge number. And we were on the front pages of all the newspapers. And now, as you say, we're many times what we expected to be, because the country is such a great place to operate. India happens to be our #1 performing market in the world for Blackstone. Our returns here on a gross basis are somewhere around 40% a year, way in excess of any other market. And we've spent our time building businesses in India to make India better. And we foresee being able to double where we are, to have a total exposure of $100 billion at some point in the future. We're rapidly growing here in India. We're the largest foreign company in the country. We're the largest owner of real estate in the country. We're the largest private equity firm here. We're in all kinds of interesting areas. And we found that operating in India is great, and we're very bullish on the future of the country. I know the stock market's gone down a bit lately.
Right.
Gets people nervous. In 20 years we've been here, this isn't the first time we've seen that. So we look at the fundamentals in the country. You have excellent stability of political leadership. Regulations have gone down from where we started. We see a very vigorous population, a lot of young people, sort of a preference for technology, technology industries. So we are very positive on the country, and it's great to be back.
Thank you. So you're talking about 100 billion of assets under management in India over, that is, if you were to double that number.
No, you gave us the right number,
Right.
And we think we can grow.
So you're the country's largest landlord. You also have a large presence in the healthcare industry in the recent past. What are the other sectors that you could get into? Would you get into areas like data centers, for instance, or some of the what is referred to here as startups, consumer-enabled internet companies, those kind of areas?
Oh, actually, our biggest exposure here, we'll continue to do more, is in technology.
Right.
And all kinds of expressions of what technology means. So, for example, Blackstone is the #1 developer of data centers in the world. And we're also the #1 owner of data centers. And this is just the start of the data center industry for India. And we can see very substantial growth there as artificial intelligence becomes much more widespread. The growth numbers are stunning in the rest of the world. And off of that base, along with the energy that's needed to power data centers, we would call it energy transition investing is a big focus here. As you mentioned, healthcare is also important given the size of the population in India. We have the second largest hospital group in the country,
That's right.
among other things, and we can see more growth in that area as well.
You worked closely with President Trump, especially in his first term. India is about to negotiate a trade deal with the US. One doesn't know exactly how much time it will take. What would you advise India's political leadership to do when they approach negotiations with President Trump's administration?
Well, let's just start out. I'm not a government official.
No, of course.
I'm just
We're very
just
clear about that. Very
somebody
clear.
who knows almost all the people involved with these types of things. First of all, Prime Minister Modi and the President had a very good meeting, which is a great start, and they agreed to have a trade agreement between the two countries.
Right.
And they also made some other mutual understandings, evidently, at that meeting. And so I think that the baseline for India seems to me to be very good. There's a good relationship with the two principals. There's a lot in common. There's a favorable attitude, each country to the other one. And I think you just sort of start with a discussion. Evidently, there's already been a number of adjustments that the two countries have made. So I know there's always a high level of anxiety when anybody brings this subject up. But I think the quality of your leadership in India and the ability to reach agreements should be very good.
Very important conversation there with the country's largest landlord. But we take a short break. Before we do that, a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are open now. You can scan the QR code and submit your entries for the second season. Take a short break.
Well, there is some important news coming in from CNBC-TV18 sources that IRDAI is planning to be ready with its regulations before the passage of the Insurance Amendment Bill. Yash joins in with some quick highlights of that. Yash.
Well, of course, the Insurance Amendment Bill would be the single largest, regulatory change awaited by the India's insurance industry. What we've been given to understand from our sources in the insurance regulatory body is that the preparation when it comes to framing regulations around the amendments which are expected as a part of the insurance amendment bill have already begun. If you remember, a couple of weeks ago, we had reported on CNBC-TV18 that the regulators formed a new committee under the chairmanship of former SBI chairperson Dinesh Khara. This committee has representation from life insurance industry, general insurance industry, the legal side of representation, as well as the banking sector representation. This committee formed by the insurance regulator is not expected to suggest any changes to what has been proposed by Department of Financial Services. All it is expected to do is to frame regulations around each and every amendment which has been proposed by the Department of Financial Services. What we've also picked up from our sources is that the regulator internally expects the insurance amendment bill to be taken up by the Parliament by the next 2 Parliament sessions. And once that has been taken up and approved in whatever form it happens, then the regulator does not want to be behind in saying that now we will frame the regulation, and hence the process to frame regulations around the insurance amendment provisions has already begun. What are the 5 most important amendments? 100% FDI in insurance sector, composite insurance license. Third one, open architecture for insurance agents. IRDA getting the authority to decide the investment regulations for insurance companies. Also, merger of insurance companies into non-insurance companies. So around all these amendments which have been proposed, the finer regulations, how they will look like, what will be the do's, what will be the don'ts, what will be the boundaries of these regulations, the preparation for that has already begun at the regulator's doorstep.
All right, we take that point, Yash. Thank you for that. Let's get you an update into the F&O end of things right now ahead of expiry. The markets have been moving off high. So we have the Nifty Bank and the Nifty IT index actually has the one which is turned and causing some supply. It was the IT index that dragged the index yesterday as well, the Nifty that I'm talking about. And over the last 3 trading sessions, Nifty has been facing supply at higher levels between 22,550 to 22,570 itself. Today's high to 22,558. Broader markets, as a result, seeing a bigger decline, mid-cap index and small-cap index, where there has been a reversal from the highs. In fact, if you look at the advanced decline chart, the red line above the green one. As we move towards expiry, the iron condor comes out again. The 22,450 call and put, both of them extremely active. Both of them have a combined premium of close to around 50 rupees, telling you that option writers are looking at 22,400 to 22,500 as the Nifty expiry. Were that to not happen, they're hedging themselves by buying the 22,500 call and the 22,400 put itself. So you're pocketing a premium of 50 rupees and you are paying a premium of 17 rupees to protect yourself outside of those ranges itself. So the option writers position for 22,400 to 22,500. Fresh longs added on Avenue Supermart and Solar Industries. Shorts continue on PB Fintech for the second day running. With that, we'll slip into a short break.
Indeed, we'll do. And before we do that, let's go across to Ajit Mishra of Religare Broking, who is joining us. Ajit, good afternoon. Thank you for joining in. We're very quickly running out of time today, but your call on the index and specific stocks as well.
Yeah, good afternoon, Hormuz. So currently we are seeing consolidation continuing in the index. So I believe that until we break 22,600 and 48,600 in the Nifty and banking index respectively, I doubt that we can see a meaningful move in the market. So that's the 20 EMA on the daily charts. Coming to the stock-specific ideas, one should continue with long and short approach. The first recommendation on the buy side in the Kotak Bank is outperforming within the sector, and we expect this outperformance to continue further. 2,200 is positionally what we are eyeing in Kotak Bank with stop at 1,900. And on short side, M&M is a candidate from the auto basket where one can initiate fresh shorts for 2,500 as a target and 2,690 as a stop.
Take that point. Thank you so much. With that, let's get you good news coming in for all the viewers. India's business news leader is just a click away. We are talking about the CNBC-TV18 app, which gives you access to breaking news, all the financial world updates at your fingertips. You can download it from the Apple Store, the Google Play Store, or just scan the QR code on your screen itself. Take that break.
Welcome back. Shifting focus to the metal space now, considering all the global developments that have been transpiring. Aditya Velagar, the senior research analyst of metals at Axis Securities, is joining us on the show. Aditya, good afternoon. Thank you for joining in. With these 25% tariffs that have been imposed on steel and aluminum, and also a proposal to impose tariffs on copper, what do you see as the road ahead for these commodities? Do you see a sharp surge in prices going forward, particularly in the US?
Yeah, in US, definitely the prices will increase, and that has already been reflected in the physical premiums, both for aluminum and copper. So for aluminum, the Midwest premium are already at the level of $800 per ton from 400, and then copper COMEX is already trading at a higher level than LME copper. So also the HRC prices in US are also at a higher level than the other regional HRC prices. So in US, the impact of these so-called tariffs and the speculation about copper tariffs, all these is already reflecting in the premiums and their regional prices.
So what does this mean for Indian metal stocks? How do you rate them right now?
So with this recent rally in the stock prices, especially for steel names like Tata Steel, we see with these current developments, the demand, calling out the demand scenario will be slightly tricky because there are a lot of moving news flows impacting the mid to long-term demand scenario. So the trading window, which has emerged since last few weeks, and that trading window, because of these positive news flows coming out from China that they have raised their fiscal deficit to 4%, which was earlier expected at 3.5%, and then the price hikes taken by the steel mills. So all these have led to the rally in the steel stocks. But now going forward, here onwards, the current news flows from yesterday is once again muddling the scenario, and it is putting a lot of uncertainty on how the demand and how the medium-term prospects of the sector will pan out, especially with these counter tariff measures from Europe and Canada on US. And furthermore, European Union has also reduced the quotas for HRC imports. And for India, the quota for HRC imports are now cut down by 23%. So all these things will have some bearing. Keeping all these things in mind, I think the valuations with the recent rally are to a mid-cycle level, and we need to see further triggers to confirm or to upgrade our target prices from this current level.
So if you could just name those names, Aditya, which are the ones that you are betting on and which are the ones that you are avoiding within the metals basket?
Yeah, so from earlier on, we were constructive on aluminum names like Hindalco, Nalco, and Vedanta, and this still remains our preferred pick because aluminum per se is not as is still strong, is still trading strong, and the demand fundamentals structurally for aluminum going forward also is expected to continue to remain strong. In the steel stock, we had positive view on Tata Steel. But with the recent rally, the valuations, we have to revisit it. So apart from Tata Steel in the steel name, we also like JSPL because of the kind of closure of their expansion in Angul. So this is our view both on ferrous and non-ferrous.
Take that point. Thank you so much for joining in and giving us your views on the metals pack. You are more positive on the aluminum space than the ferrous and non-ferrous space. The valuations more at the mid-cycle level. Would be very interesting to see how the aluminum plays out as well, because we saw a decline in alumina prices. So to that extent, Nalco would be impacted as well. With that, we take a short break. Enough discussion on the listed side of commodities itself, but to get a deeper insight into what really is taking place in the commodities segment, and specifically sugar, Manisha Gupta joins in with Deepak Balani, who's the Director General at the Indian Sugar and Bioenergy Manufacturers Association. Stay tuned.
Welcome back. A stock that has been in focus all through the day is MTNL, and we talk about that in our Value Plus segment. And news that came in yesterday evening, where there's a written reply in the Lok Sabha which stated that MTNL has earned around 2100 crore rupees from the monetization of land and buildings, and an additional 250 crores from the monetization of close assets, which includes towers and fibers. Now, this almost comes across as small joys of life for MTNL, considering the debt burden and the losses that it is under. Now, over FY15 to FY24, it has accumulated losses worth over 29,000 crore rupees. In addition to that, as of FY24, it had a debt burden or total debt of around 30,000 crore rupees. So, accumulated losses plus debt, and it has already been classified as a non-performing asset by most PSU banks that have exposure to it already. Last year, we had reported about it extensively on CNBC-TV18, and the cumulative exposure as of October last year stood at around 7,900 crore rupees. Now, when it comes to shareholding, of course, the government has a lion's share in this, around 56%. But retail too has significant presence in MTNL, along with a 13% stake that LIC owns. Now we talk about those retail shareholders with an share capital less than 2 lakh rupees, which is the small shareholders, as we call that. Look at the increase in number. 1.7 lakh shareholders as of December of last year. That number has increased to almost 4.5 lakh, despite the troubles that the company has been facing on the debt front and so on and so forth. And even in percentage terms, from 14.5%, that number has gone up to almost 21% as of the December ended quarter in 2024. Has it been any rewarding to shareholders holding on to shares of MTNL? Well, not really. It had, from between 2001 and 2009, it paid around 10 rupees a share as dividend cumulatively, and since 2009 it has not paid a single rupee as dividend, considering the fact that it has remained loss making. Even BSNL turned in a profit last time around, but MTNL is yet to turn profitable for quite a while. On what the road ahead for the company, well, the government has ruled out any privatization plan. It's been running on negative net worth so far, and the government has already infused almost 3 lakh crore rupees as packages in various tranches. 70,000 crores first up, then about 1.5 lakh in 2022, then almost 90,000 crores in 23. So you're keeping pumping in the money. The share price, though, in 2006 at one point traded around 250 rupees, down to an all-time low of 4 rupees in August of 2019, and recently also it tested 100 rupees and then it halved, currently trading around the mark of 50 rupees. So, well, that's our Value Plus segment on MTNL. Is there any reason to rejoice? Well, the ball is in the shareholders' court for now, 13.5% higher on the stock. But over to Manisha Gupta for our Commodity Corner.
Thank you so much for that, Hormuz. And joining us is a special guest, Deepak Balani is DG at ISMA, and he joins us to talk more sense on what really seems to be happening within the sense of sugar production. Mr. Balani, hi, thank you so much for joining us here at CNBC TV18. What's your first sense on the production numbers itself? Because every estimate that your agency seems to be coming out with, or various other associations, we've seen a downward revision continue. Is that a cause of concern?
Yeah, thanks, Manisha ji, for having me in your show. Yeah, we have of late seen in the last estimate, ISMA had estimated almost for 272 lakh tons. And due to the lower yield and slightly lower recovery in Maharashtra, and also in UP, where we have seen an effect of red rot in some pockets, we have seen a lower production. We have revised it to 264 lakh metric ton, and which perhaps I believe is still sufficient, because if you see our balance sheet, we opened our stock with 80 lakh tons and consumption of 280 lakh tons, which basically is based on whatever the stock which have been released till now and the dispatches and estimated sale in next 6 months, considering everything, even considering the summer and the festivals. We are estimating maximum 280 lakh tons, and having also seen taking into account around 10 lakh tons of exports, we will close this session at 54 lakh metric ton, which I believe is a very adequate and sufficient stock to close with. Having said that, next year, the crop looks very good because we had very good monsoon in 24, and the reservoirs in Maharashtra and Karnataka are quite full. The planting reporting is very good. So I believe with the early Diwali next year, the mills are going to start on time. So I don't see any sort of concern as far as the sugar supply and the prices are concerned.
Talk about the prices itself then, and various agencies report that sugar prices have gained up by anywhere between 10 to 15% since mid-January. I do understand that the prices still are much lower, below your cost of production, but how are you looking at this price rise? And with Holi, with festivals, with the summer demand season also coming in, are you looking at demand and prices both go higher?
If you historically see, first of all, the Holi demand is already done because Holi is tomorrow. So all the demand for the Holi has been already taken care of. And what we have actually seen is there has been a kind of a subdue in the demand. So demand from the bulk consumers are not as bullish as it used to be. So we have seen a downtrend in terms of the demand. Having said that, almost, as I said, 137 lakh tons have already been sold in the first 6 months. So considering, I don't think we will go beyond 280. But as far as the prices are concerned, what you are taking into consideration is the prices in December, which was much below normal. It was quite abnormal because the Maharashtra and Karnataka were selling the sugar at 32, 33 rupees, which is much below the cost of production of around 40, 41. So I believe that was a very unusual scenario. So it is not correct to really compare your December, January early prices with now. But if you do a completely deep analysis, the retail price for last 2 years has hardly increased. For example, 22-23, the retail price was 42, around 42.5. In last year, 23-24, it was around 44.5. And at the moment, it is around 44.8, which is hardly less than 1%. So I don't see that price is of any concern as of now. Even the wholesale price has not really moved up. It was around 4134 last year. It is 4163. So I believe we have to also look at a very holistic price. We need a good price for us to pay the timely payment to the farmers. Having said that, you see, it is very, very important to tell you that in last 2 months, from mid of January, because of the certain announcement also and because of the stability in the domestic prices, we have had a very good payment to the farmers. So as on mid-January, it was around 69% was paid to the farmers. At the moment, almost 80% of the cane arrears have been already paid, which is perhaps a very good record if you see the past years. And also for 23-24, which has actually never happened before, almost 99.99% of the cane arrears have been paid. So I believe this is a very, very good scenario. And I believe we need a viable prices for us to be viable and also make the regular payment to the cane farmers.
Mr. Balani, also, what's your sense on exports? Because with the kind of, would you say the balance sheet looks tight right now? Because we're looking at a lower opening stock in the next season, much lower than what we've seen in the last couple of years.
No, I believe, see, but the government always wanted a 2-month stock. So if you see 2 months, what we require around 47 lakh tons. And we are closing with 54 lakh tons, which is still 7 lakh tons more than what actually we want. So I believe there is no concern. We have almost done 300,000 of exports physical trade. Almost 3 lakh ton is all contracted. So I believe 6 lakh ton export is almost finalized. And in next few months, whenever the situation is good and we have a better prices, I think this 4 lakh ton also will be done. So we have already considered the export of 1 million, and then we have calculated a closing stock, which looks very adequate and healthy.
Well, of course, you've told me earlier that out of 1 million, nearly 3 lakh tons is dispatched and 3 lakh tons is contracted. That thing is in. But what is your sense also on ethanol diversion? Because that is a number that you also have gone down on.
See, originally, we had estimated a diversion of almost 40 lakh tons. But we had revised that in December to around 37.5. And that is perhaps because of the 2 reasons. It was revised based on a certain less availability of cane. But even after January, when the prices were not revised for juice and B-heavy, and government giving an option of changing the feedstock, there are some reports that the mills have diverted or changed their feedstock. And as a result, the quantities are coming down. So as per our latest estimate, we'll be diverting almost 35 lakh tons to ethanol, which is almost 5 lakh tons less than what we have originally estimated.
All right, Mr. Balani, thank you so much for sparing time and joining us this afternoon. Manisha, thank you so much for joining in as well. With that, we call time on this edition of Halftime Report. We leave you with the Nifty still at the 22,450 mark. Business Lunch takes over on the other side. Stay tuned.